Welcome to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Brackett, and welcome to the show. All right, folks, welcome to another great episode of We Build Great Apartment Communities, the only place where you come to learn how to take apartment buildings and turn them into amazing communities. I have another great guest. His name is Mike Desrosiers. And so Mike is CEO and managing partner of Growth Capital Partners, LLC, and Smoke Ranch Group, LLC. He's a licensed realtor in California, sponsored general partner of over 600 units in Texas, Nevada, and Kansas City, Missouri. Mike has extensive education in multifamily syndications, asset management, and acquisitions. His background includes a University of California, Berkeley education and several successful companies, including 30 years as CEO of a promotional marketing agency in California called GrowCapToday.com. Did I say that right, Mike?
Yes. Well, Silicon Maps is the promotional advertising business. GrowCap's my real estate business.
Okay, got it. Well, hey, bud, welcome. Welcome to the show. Great to have you. Really excited to get into this. And my first question is, you and I were just talking really briefly about the markets and some things that were changing, or some things that I see changing, some market dynamics that I see shifting right now. Maybe, if we can start, Mike, with just, really briefly your experiences in this business, right? I know you've been doing this for some time. Maybe just a quick synopsis of, your experiences in this space. And then we'll get into some of your observations right now in the market and just a pulse on what you're seeing and what you're doing for that matter.
Awesome. Sounds terrific. Yeah. So I've been doing, I'm sorry, go ahead.
Go ahead, please. Go ahead.
So I've been doing, I've been doing single family rentals for pretty much my entire life, many years, and single family flips and so forth. Always had rental units of one type or another. Multifamily has been fairly new for me, just a little over 3 years ago getting into it, and has been scaling up quite a bit. So I'm general partner, as you said, over 650 units. It's actually closer to 850 units at this point with what's currently ready to close. So it's been going pretty good. Focus on the Texas market, Kansas City. I'm partners on a 426 unit property in Kansas City alone. So that bumps the numbers up quite a bit. Sure. And then I have property in Las Vegas and also single family still in California. And I keep my pulse on the market. There's no doubt about it. I'm old enough to have seen the cycles. I've been through several of them, right? Old enough. I was property owner during all of those downturns and upturns. So I know the pain. I've been there, right? And so I for sure keep my eye on that pulse all the time. I still am in a buy mode. I still feel strong about the market. It's a weird set of circumstances, of course, that have been going on. People were worried about the economy crash prior to the pandemics. And, that was a big concern before that even happened. And honestly, kind of amazing that we rode through it with, as little pain as we did, at least in the multifamily world. But of course that, can catch up. Now we have inflation as for sure our major, obstacle to overcome. But we feel, on my side, we feel multifamily is going to ride along with it. I mean, rents are going to go up along with the cost of bread and cars and gas and lumber, everything else. It kind of has to. There's no real reason why it would fall behind. People need a place to live. And, we still work on the opportunity. We primarily focus on value add, which we feel offers some forced appreciation. So we don't have to sit there and wait for natural appreciation. We can take communities that kind of need a little love and give it to them and make them a better place to live and a better community for the tenants. And tenants are usually willing to pay more to stay there and, to try to keep occupancies high. That's primarily been our, business model, and we feel pretty strong about it at this point still.
And so, when you're going in and making an assessment to make a purchase, right, when you're doing your analysis before you put an offer out, what are some of the fundamental things that you're looking for, especially, considering that you're your comments around us starting to experience some inflation, right? Because a lot of what I'm seeing out there, there are deals that are predicated upon what I feel in many cases are projections that, you know, might be outpacing the rate of inflation. and so, what are you seeing out there?
Well, I absolutely agree with you, John. No doubt. Yeah, I mean, anybody who's been in this business for a while and seen it, you know, can see exactly what's going on. You know, it's just like, it's all you can do is hedge your bets. And so we look for properties that have under market value, or under market rents current. That's usually, you know, due to, you know, lack of renovation or deferred maintenance or poor management. And we see all of those going on, frequently and sometimes all together. And if you take that, combined with a analysis of the location and the competition in the neighborhood and type of neighborhoods, you know, finding like, you know, we just closed on a property in Fort Worth, that we paid a lot of money for. There's no doubt about it. It was a very compressed cap rate, going in. But, you know, it was a 1984 build and everything was all original inside, all 84 kitchens and 84 appliances and so forth. But all the other properties that are around the neighborhood were older, actually like late 60s, but completely renovated and done really nice. We went out to the properties and visited them. You know, they all really look sparkling and shiny. They're capturing pretty high rents, much higher than the rents in our building, primarily because of the deferred maintenance. It's also a good neighborhood. It's a nice B-class neighborhood that kind of in Fort Worth, you know, kind of old money section of town. So it kind of checked all the boxes, and if you're able to check those, it hedges your bets. So it allows you kind of know that you can renovate and get increased rents. It's a popular neighborhood. The competition is, you know, you will be better than the competition. And so if nothing happens and the economy stays flat, we're still, you know, we can still hit a home run out of this property.
And when you say you can still hit a home run out of the property, how are you making that assessment, right? I mean, how are you quantifying home run?
Yeah, well, home run is basically, you know, going, attaining better than our projections.
Okay.
That's what I consider a home run. I mean, a lot better, not just a little better, but a lot better.
And so let's use this deal as an example. Okay. What are you projecting out for an internal rate of return?
It's about a 20% IRR. That's in taking in consideration that, you know, we'll be doing a refinance within the property and returning some capital to investors as well. So it increases that. But the AAR running about 20%. It's 7% preferred return going in, which, you know, we know is going to be tight going in, but we feel very strong with our business plan, and we feel like we can obtain that fairly easily. We have a very experienced team that is is used to value add and knows exactly what to do, and we get in there, do it quick, and be done.
And so on this particular deal, how are you planning for your renovations? And is it over a 6-month period? Is it a 12-month period? It sounds like it's a very heavy renovations with roughly maybe 200 units.
No, actually, it's a smaller property. It's only 60 units, but
okay, got it. I just 200.
I do have. We're in contract now on another 227 unit property in Pasadena, Texas. Yeah, and that's obviously a bigger value add. Although most of that was renovated in 2000, so we're kind of picking up what was left, and then there's been some deferred maintenance. But back onto the other one of the 60 unit, we're just and actually with both properties, we're going to do them organically. So we're just going in. Day one, we're just trying to stabilize the property. We'll spend money on the exterior, trying to, give it some beautification, taking care of any deferred maintenance, and working on the tenant base, cleaning up, everything that we feel has not been run properly, right? It's had poor management actually in both properties. And at that point, then as the leases expire, we'll be increasing the rents at that point, and we expect some tenants to move out, and then we're prepared to go in and do the renovations as they move. And of course, the good tenants that are in there that we want to keep, we always offer them to move into the renovated units first.
Sure. So in this market, when you think about the cycle or the life cycle of a purchase, right? You have the acquisition component, you got to finance it, debt and equity, ideally, you have to manage it, and at some point you sell it off, right? So when you think about that life cycle inside of the space, which of those four components do you feel is going to be the most pressing or the most important for an operator to gain control over or of as we head into this new cycle?
Our business model is kind of fix and flip. It's pretty much it's fixing and flipping, apartment buildings, which it's obviously not done as fast as a home. It's done in more of a 3 to 5 year turnaround time. But our ultimate goal is the same. Our ultimate goal is to buy it, fix what's needed, or increase the value of the property through renovations and increasing rents, which, obviously bringing up the NOI. And then we're done. And at that point, it's about exit. It's about how to sell it. And when we exit is going to depend on the market. So when we underwrite the properties, we underwrite it in several different ways and projecting different kind of economies. So if it's like, for instance, on even particularly on the 60 unit, it's kind of small. So we'll get through the renovations fairly quickly. We'll get through probably, 60, 70% of the renovations in the first 2 years. And at that point, we have in our underwriting, we have an element to refinance. We're in a bridge loan going in. So we'll refinance, but give some of the investors money back, and as well as bring any additional money for CapEx that might be needed. But that's kind of if the economy is not so good or we don't look like it's a good time to sell. But if in 2 years from now and the market is really strong still, then we may just decide to exit out of the property, complete the renovations maybe within year 3 and then sell and be done, and then pick up another property and do the same, because it becomes kind of rinse and repeat when you've done it enough times, right? You have the same contractors, same property management, same people all within that market. So it's pretty easy to, implement your business plan and complete it on time.
Sure. And then talk a little bit about management, right? Management of your assets, especially in this market. It sounds like you've worked with a lot of, or the same management team or company for maybe, a couple of years now. And so what have been some of your biggest learning lessons from dealing with, from managing, especially apartment buildings? Because it sounds like your model, fairly short-term hold period, right? I mean, as long as you create that value, you're looking to exit right away and capture that and move on to the next one. So in terms of the experiences gained operating in that short cycle, what are maybe the top 3 big takeaways that, you can share with our audience about management? Our
management's pretty good. We definitely, obviously, in the townhomes property, they are 60 units in Fort Worth of townhomes. They have garage units, half have garage units, half have carports. And the previous management was not even charging any difference between the two. They also weren't really capturing a lot of, the late fees and other fees that, kind of come along with that when you have tenants not paying on time. And our management is very tight on that. We run reports on it clearly and frequently, and we stay on top of that as well ourselves, because there's always one or several people that are managing the manager. And so we just make sure that's all stayed on top of, and they're used to that. Same with the Pasadena property. The management just was not capturing a lot of the fees and seemed to be a little loose on the accounting as well too, right? As far as it took us some time to really get all the proper documents, and it kind of came in a little willy-nilly. So we took some time to put it all together, but we don't do that. We do it, with a professional management team and professional software that's designed to do that, and we keep up on that.
And when you say Pasadena, meaning Houston?
Yeah, Pasadena, Texas. Yeah. Not Pasadena, California.
Yeah, familiar with that market. So why Pasadena? Just out of curiosity, what is it about this asset that you find, you find some value in?
Pasadena has kind of been known as, the potato patch out there, oil, more driven market. But, the greater, Houston MSA is growing leaps and bounds. That just seems to be a nonstop machine that keeps going. And I see some, I just see some growth going on in that market. Pasadena, again, is one of kind of the suburbs. But I think there's an opportunity for growth there.
Yeah. No, I think so as well. So, what's next? What's next? You talked a little bit about, where you are today, some of the things that you're looking at, some of the things that you've done, how you're looking at opportunity. And so what's next, right? What's next, or how are you looking forward? I know no one has a crystal ball, but it would be really nice to shine yours up a little bit and start speaking to it.
Yeah, I think, that's it. I mean, we're still in the buy mode until we see, indicators going in a different direction. We don't, you have to be careful for sure on where you're buying. Pasadena doesn't have the same hype as obviously as Fort Worth. That was a great market. It is a great market. But we're just Texas is kind of a focus for us. We just have, like I said, we have all the places, all the tools in place there in that market. So it's very much rinse and repeat for us to, take over a property, and we kind of know exactly what to do and how to do it, and we get it done efficiently. And we know how to cut costs where we need to, and we know where to do improvements where we need to, but not to over improve. And so we feel confident in that market. We're just keeping our eyes open for that type of value add components.
Yeah. And so what are some of the key value add components that, you've had a lot of success in, right? Because it's one thing to have conversations about value add components. It's another to really understand how to identify them, especially in competitive markets, right? Because usually those components are not as visible as people may think. If they were, everyone would be chasing those opportunities and then paying for that. So with that said, what are some of the things that you're seeing right now that maybe a lot of folks are not, right? Some of the hidden components that will help you quantify that, hey, look, there's some value here. This deal is undervalued for X, Y, and Z reason. What are some of those things that are popping up in your mind or that you're seeing?
Yeah. Sure. Well, I think, the main component is rents, right? And, digging in to finding out what the competition is in that market. And a lot of people will just run, they'll run comps online or CoStar or run it on, what they can find online. But the market's changed drastically. And so we actually get, secret shoppers to go in and call the competition and, basically pretend they're renting an apartment or looking to rent an apartment. And they'll go in and call and find out exactly what they're asking for rents and ask about how much, when they've been updated and what the square footage is on them and even try to poke around about the occupancy, asking, how many they have available if they're, we're not thinking about renting this month or maybe, it might be next month. Just wondering if you're going to have some, space, some units available. Do you have 1 bedroom, 2 bedrooms? I mean, obviously you can't sound too sophisticated when you're calling, but, by calling pretty much all the competition around the neighborhood when we're targeting an asset, it gives us a very immediate, up-to-date rent comp. And we find it many times very different than what you find online.
Yeah.
So that can be good, that can be bad, but,
Can
If the competition is saying, yeah, we have a waiting list, or, no, sorry, we have one unit left and it should be gone in a few days, and I don't have anything coming up for the next couple of months, right? I mean, those are all good signs that, you're buying in the right neighborhood. And so then you just have to try to figure out what amenities that property has and compare it to what your property is offering. Because, people don't really want to move. I mean, they really don't. So if the rent goes up to a certain point, I mean, they might check around, but if it's the same rent across the street or down the street, they'd rather probably stay in their own apartment unless it's something better. And that's what we try to analyze. I think that's probably the case.
You bring up a really good point. There is a property that we still own, and one of the questions that we got into the habit of asking our property manager is, hey, look, why are they moving, right? Or where are they moving from? Why are they moving into the property? Why are they moving out of the property? Yeah. And I think some of that is pretty telling, right? Because you tend to learn a little bit more about the market when you're understanding why people are transitioning. So what have been some of your discoveries, right? When you're unleashing your secret shoppers to help you understand, what market you're buying into and the surrounding competition. What do you typically learn about prospective tenants moving in, right? Why are they typically moving into that building or that area rather? And then when they exit, why are they usually exiting?
Right. Yeah, no, that's a great point. And that's exactly what you want to find out. Primarily it's about the location and, the accessibility to, work or amenities, shopping or wherever, whatever is there, accessibility to, the even just the freeway and road to be able to get to work. But primarily I think mostly it's about management. I really feel that the management, you can read reviews on certain properties and you see it, it can be riddled with, I called the property manager and they didn't respond for 2 weeks and, I can't get them out. They came once and the guy never showed back up again, or, they're terrible. And, everybody, wants to rip into a property manager if they get a chance to. Sure. So it's very, very transparent online. Of course, you have to read through the lines, but, we try really hard. Part of our team, one of our team members will be, in charge of keeping an eye on that, on the Google, on the reviews, online reviews. And we make sure that, we have a checklist of how fast, complaints are handled and when it's handled. And we keep track of that. And we have a certain criteria that we try to keep up on. We are really focused on tenant, and making the tenants happy and, making sure that everything is taken care of. And I think that's a big part. I mean, when they're taken care of, their needs are taken care of one way or another, they do want to stay.
And so you bring up a great point. So it sounds like, you've come up with some pretty good systems on how to manage, or rather how to follow up to make sure that your management team is providing great customer service, and you're setting some timelines or some benchmarks to measure them against, right? Otherwise, everybody's amazing.
Exactly.
Otherwise, everybody's amazing. So what does that look like? What does that checklist look like? Can you point out maybe some of the KPIs, or in this case, some of the indicators that you're using, or the standards or the benchmarks that you're using to manage your team to?
We have checklists that where if a complaint comes into the management office and we want that tenant responded to within 24 hours, and then we want the problem solved within 3 days, unless there's a part that needs to be ordered or something that's causing that to be delayed. And then we follow up with that tenant afterwards to be sure that it's been handled and that the tenant is happy. And again, we're just monitoring these online reviews, and, we're online centric to our tenants and asking them to post positive reviews, when applicable. But we really try to keep that up because that also helps with the occupancy. And when people are looking to rent a place, they Google the property and try to find, the good or the bad on the properties.
Sure.
So we have multiple response on that.
Well, Mike, we're approaching the end of the show, and man, I want to thank you for being on. It's been a really great conversation. A lot of content packed into, a 30-minute conversation, which is great. So when you look back on the last 3 years, what have been, maybe if you could do this over again, this journey that you're on, what would you have done differently, if anything at all?
What would I have done? I would have done sooner. I would have done bigger. Those are all too, fear is what stops us in for most of this. And I'm sure anybody in real estate, including people that bought their first house, when they were 22 years old or something, still, gosh, if I would have done it when I was 21, I would have made more money.
Right.
No, and that's kind of extreme, but, seriously obviously we look at it, if we got into this, 10, 20 years ago, or when we were young, young men and young women, and, there's been a lot of wealth that's been created in it. Also the size of the units and the multifamily, especially in the syndication world where you're just raising funds, I find the bigger units have been, it's the same amount of work, right? Same amount of work to close a 60 unit as it is a 600 unit. It really is. And it's just adding, zeros onto the end. You're not answering those phone calls from the tenants. Your manager is doing that. You're just having a weekly phone call with your manager, and it's the same weekly phone call no matter how many units it is. There's obviously more meat on the bone, so to speak. So it attracts higher caliber partners. It attracts higher caliber property managers. You really get the best of the best when you have a large, 600 might be extreme, but, it's, again, on the 426 unit, the property managers were fighting to get that business for obvious reasons. The partner is a high caliber team to work with. There's a large group, so it's not a ton of work for any one individual, but everybody puts in their 2 cents and gets the job done quickly and efficiently. And the money raise was probably easier to raise on that, which was like a $6 million raise, than it is on some of the, $2 million raises, because investors are the same way. They all kind of want to be a part of something big, right? And you talk about, 426 units, you're going, wow, yeah, I'm interested in that. I want to be part of that, even a small piece. So that's my take.
Well, awesome. But I really appreciate you being on. Mike, thanks for being on. So what question do you have for me, that you think can add some value to our audience before we transition? I've been asking you questions for a good 30 minutes, maybe 40. Question
for you would be, I know you were talking about some commercial, and I'd love to hear more of that. Obviously, you're talking about higher cap rates in some of the commercial market. And there's absolutely more than one way to do this. There's no doubt about it. For me, I tend to stay in my lane because that's kind of what I know best. But I know there's a lot of money made in a lot of different asset classes.
Yeah. No, I really appreciate the question. I think it's a great one, right? For me, it's always about where am I going to get the greatest return on my capital, right? And my investor capital. And sometimes it's not always things that have a little bit of ambiguity to them. Usually the returns tend to go up, right? When there's a little bit more difficulty, a little bit more ambiguity. But what I find a little bit interesting in a market like this, and, we kind of talked about this earlier, is, when I'm looking at, say, an apartment building, and I'm looking at, I'm comparing that to a single tenant, triple net lease, right, with a national credit tenant in there. And I'm looking at the apartment unit on a leveraged basis. My return on cash is 5.5%, right? Maybe 6%. But to get to that place, it's going to take me a year, maybe 14 months to implement the value add plan to be able to realize those returns, right? So if I average year 1 and 2, then my return on cash now is at, say, 3%. Okay. Well, if I look at, say a triple net deal, right? Walgreens. And this is something that I'm actually working through right now. Okay. Several of them actually, because I'm having a very difficult time justifying the return on cash that I just explained when I can go out and pay $4 million, okay, for a 30,000 square foot building, 30 or 40,000 square foot building with a Walgreens in it, trading at a 6.8 cap, right? Right. So I come in with $1 million, NOI 272,000, put $3 million worth of debt on it. Okay. Netting $100,000. Okay. Return on cash. So I put $1 million down, return on cash, 10%, right? And the tenant is responsible for everything, including the roof. So, year one, I'm generating a 10% return on my cash. Okay. With very little time and energy requirement on my part, right? So again, it's like, how do I justify deploying $1 million in something that I have to chase for 2 years to capture on average a 3% return on cash? And then year three, I'm generating a 6% return on cash, assuming that we hit our targets versus buying into something that's right, a lot less work, same amount of money for a much higher return on cash or yield, right? With a credit quality tenant, great building in a really good location. So, and that building, by the way, has multiple uses, right? If for whatever reason Walgreens, they exit, I know I can still lease that building up just based on the location and, just the composition of the building, right? I mean, and the square footage and how the building's made and just some other components to it. So, anyways, those are some of the things, but I think staying flexible like that in your thinking, just gives you more options and maybe a little bit more protection, right, with your investors. I think I wouldn't be doing my job, okay, deploying other people's money alongside my own if I didn't look at the best place to deploy capital. That's really what I think about. And, I'm not a company with $1 billion balance sheet, so I have to be a lot more discerning in how I'm making those assessments. Ultimately, we all talk about risk and return. And so how do you justify that kind of return for the risk that I just described when you have better options to your right? Right? Yeah. I mean, that's what I'm talking about. Some of this stuff is not making any sense. But again, I'm not the only person looking at this like that. You have a lot, and I think that's why industrial buildings have been just on a tear, right? And they have been because investors are looking at that same thing. It's like, okay, where am I going to get the best return on my capital relative to what's available right now? And I think that's something that is actually going on right now. And same thing for office buildings. I'm starting to see that. I looked at an office building in Austin that I thought made, a lot of sense, kind of a unique scenario because, already had someone that wanted to lease the building, pretty good business, right? A marketing agency or advertising agency, fairly profitable. So, hopefully that answers your question, right? It's really about looking at things in a way that will generate the greatest return on my capital, okay, relative to time and energy. And that's a formula that's worked for me, worked for my partners. Sometimes it takes a little bit of work up front because you have to look at things maybe slightly differently from an apartment building, right, to now a commercial, whether it be a retail or industrial building or an office building in this case. In this case, it's retail. But the change is not that much, right? I think what really changes is you understanding really how the leases are written and ultimately what the tenant is responsible for and being able to, model that out and then understanding the MSA and the economics and just being willing to do a little bit more research on, in this case, one tenant. Not good, not bad, but relative to what I described earlier, I think, there's some reasons why it's important to consider that. The downside is you don't get the leverage that you do with 100 units, right? Or 200, or in this case, 400 units. So if you bump rents by $20, that's, $8,000 there. That's, that's the downside. You don't get that kind of leverage on a single tenant.
Right.
But, on another deal, however, that I'm looking at that I put an offer out on, for example, the way that the rent bumps are written, it was 10% over a 5-year period, and the second option period was 15%, right? So that's 3%, even though it wasn't really compounded. There was a consumer price index clause in there that if rents or if the CPI, if inflation, for example, went up greater than what the rent increases were, what the rate was over the base rate, that we would adjust then to the CPI, right? So I'm like, okay, that's great. Well, now I'm still protected with inflation. And so it made a lot of sense to me, right? So anyways, hopefully I answered your question. Maybe a little bit long-winded, but, I think there's always, one of the things that I find fascinating in this business is there's always a way to create an opportunity. It sometimes just takes looking at things a little bit differently. So
that's right. Absolutely.
Yeah. Hopefully that made sense, but I really appreciate the question. Great question. So Mike, how do people find you?
So they can, they can contact my website is growcaptoday.com, and they can go onto the site. They can sign up for our Investor Club. They can email me direct from that website. And that's also on Facebook, Mike Desrosiers, LinkedIn, same Mike Desrosiers, and GrowCap. Pretty much all over. So I'm easy to get a hold of, and I enjoy talking to people about multifamily. So, I encourage anybody to reach out if they want to just, chat about it. I'm happy to get on a conversation. It doesn't have to result in any dealing, but I just like to discuss it. I enjoy it a lot.
Awesome, bud. Well, I thank you again, Mike, for being on. You've been a gracious guest, and I want to wish you continued success and, look forward to connecting at some point in the near future.
Yeah, thank you, John. Thank you for having me.
Yeah, thank you. Appreciate it. Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Brackett, bringing you things you can implement right away.